It's time now for tonight's KMIR financial report. Stocks were largely flat today as many of the market's biggest trading favorites lost their momentum. The House and Senate both passed bills today to provide aid to the Ukraine, back a $1 billion loan guarantee for the Kiev government, and impose more sanctions on Russia over the annexation of Crimea. And the head of the St. Louis Federal Reserve Bank says that the Federal Reserve should start raising short-term interest rates early next year. It would be the first rate hike since 2006. Joining us now is KMIR financial analyst Brian Amidei to talk about those potential interest rate hikes. Brian, first of all, is this a good sign about the economy, or is this something we should be worried about, the increase in interest rates?
No, this is actually a good sign, Gino. At the end of the day, they're reading economic numbers. GDP was upgraded from 2.2% in the fourth quarter up to 2.6% for the fourth quarter. Economic growth was a little bit better than expected, but the Fed really has a concern. They have a quandary on their hand. The Fed really uses interest rate policy as a way of combating recession. Now, we've been very fortunate. We haven't had an economic slowdown since the Great Recession in 2008, but we've had a very anemic uptick in the economy. So what the Fed is hoping for is that the economy is going to start moving along. They will be able to raise interest rates. Interestingly enough, the Fed has reduced its Fed funds rate expectations by 2016 down to 4%. Typically, the Fed funds rate is right around 5.25%. So in this new economy, if you will, interest rates are going to be low for a while, but the Fed does need to get off of a zero interest rate mark.
All right, that lowering of the prediction you just mentioned, what does that mean? What does that tell you?
At the end of the day, the Fed really needs to try and get rates up. They want to do it as quickly as they possibly can. They need the economic data to come in strong. When the Fed raises interest rates, typically the stock market goes up and the bond market definitely goes down. And the reason for this is the Fed is raising interest rates because the economy needs to be slowed down a little bit. While over the last 5 years we haven't had an overheated economy, we've had an economy that's been very sluggish that we need to try and heat up. So the Fed has had the gas pedal to the metal. They're trying to reduce that over time, and they can't get there quick enough because their concern is if we do go into another economic slowdown and we haven't had any fiscal policy addressed, which is tax adjustments, the Fed's going to have to go it alone, and that's going to be very difficult for them at a zero interest rate policy.
All right, KMIR financial analyst Brian Amidei once again saying we need lower taxes. Thank you, sir.
Thank you.
We'll be right back.